Hey, everybody. I think we are just waiting on Mara to join. All right, it looks like we have Mara. I'm going to stop sharing my screen. All right. I think we're good to start.
All right, Jeremy, thank you. All right, let's get the ball rolling. Good afternoon, ladies and gentlemen. My name is David Tam. I'm the chair of the Funds Commission. Welcome to this November 29th, 2022 meeting of the City of San Diego Funds Commission. We're going to do a quick roll call to confirm commissioner attendance. When I call your name, please unmute yourself and say present. Commissioner John Peel.
Present.
City Attorney Mara Elliott.
Present.
City Treasurer Liz Correa. Liz, I think you're on mute. Liz is having audio issues. Can we take her chat as a present vote? Is that good? Okay, perfect. Thank you. Your attendance has been noted. For the record, we do have a quorum consisting of Commissioner John Peel, City Attorney Mara Elliott, City Treasurer Liz Correa, and myself, Funds Commission Chair David Tam. Also present are Brett Bartolotta, Deputy City Attorney, Frank Sutton from Northern Trust, Jeff Knipp from Siegel Marco Advisors, and Jeremy Shortis, or Office of Boards and Commissions Liaison. Before we get into today's agenda, I would like to provide some guidelines for the logistics of the meeting. Please note the buttons on your Zoom meeting bar that pops up when you move the mouse, and the camera icon is to activate your video. The microphone is to mute and unmute. Please remember to stay muted when you are not talking and to unmute yourself when you speak. You will also see the chat window button. Please keep your chat window open at all times. As you will be using the chat to signal when you'd like to speak. When wanting to make a motion, second a motion, or participate in a discussion, please type speak in the chat box and I will call you in the order entered. Please refrain from using the meeting chat for anything other than signaling that you'd like to speak in order to comply with the Brown Act. Thank you for your attention to these guidelines. Let's move on to the approval of the minutes for the August 30th, 2022 Funds Commission meeting. Are there any changes to the minutes that were provided? Look at the chat. Looks like we're good. Is there a motion to approve the August 30th, 2022 meeting minutes?
Motion to approve.
I think that was John, right? We have a motion by John Peel, second by Mara Elliott to approve. We will now take roll call to count the vote. Commissioner John Peel.
Aye.
City Attorney Mara Elliott.
Aye.
City Treasurer Liz Correa. I think she's.
Aye.
There she is. And myself, Funds Commissioner David Tam, Funds Commissioner Chair David Tam votes aye. So that motion passes unanimously. Now let's move on to the informational items. We will take up item number 1. Report from Northern Trust regarding Mount Hope Cemetery Fund investment and performance review, including bond discussion. I'd like to welcome Frank Sutton from Northern Trust. Make sure he's on here. Yep, he is. I'd like to welcome Frank Sutton from Northern Trust to present this item.
Hello, thank you.
Thanks, Frank.
And is it okay if I share my screen now?
Yes.
Then. All right, hopefully you can start seeing my Adobe app right now.
Yes.
Tell me if you have any difficulty with that. And thanks for your time and thanks for having me here. Just wanted to start with the portfolio review as we discussed on the agenda. We have a few things to discuss. One of those is, I think later in the program, in the agenda, regarding an action item, we're going to talk about the investment policy statement. And but for now, let's go ahead to the executive brief section on page 4. You can see the way the portfolio is allocated. Maybe I'll zoom in just a little bit. Does that make it any better or less better?
We can see it.
Okay.
Yeah.
On this page, you can just see that the portfolio allocations as of the end of the third quarter, September 30th, 2022, also illustrating the change in the portfolio since June when we last reviewed it, and the differences in those allocations versus policy statement. So not a lot has changed over that period. We didn't really do a significant rebalance since then. And everything remains within the boundaries or the ranges that are set by your policy statement. On the bottom of the same page, you can see performance highlights. For the third quarter, the portfolio experienced a negative return of about 5.7%. That is relative to the policy benchmark, which generated a return of negative 5.1%. Year to date, negative 18.8%, and for the benchmark, negative 18.4%. Looking at the longer term periods over 3 years, the portfolio is down an annualized 1.2% versus annualized 0.1%. And then over 10 years, 3.8% annualized versus 4.0% annualized. And I'll just because it's so deep into the fourth quarter, I thought I would jump ahead for 1 second. On page 30 of your report, I added the October performance, where we had quite a rally that the market was bouncing back in October. So the portfolio was up 3.4% during that period, compared with the benchmark, which is the benchmark is a pretty straightforward, fairly simplistic benchmarks of 35% equities, 65% fixed income. And so we have a little bit more of a rich mix. So the differences between the benchmark and the actual portfolio performance are a little bit more pronounced than might otherwise be the case. One of the reasons why we want to talk about an adjustment to the policy. But in any case, that did improve the longer term numbers as well. If you just glance at the 10-year number through October, we're just ahead of the benchmark with a 4.2% annualized return. And on the next page, a few highlights about what was going on in the third quarter. It's been a very volatile year. The third quarter was no different. We started the quarter with a rally that was coming off of the lows toward the end of June in the equity markets, and the market is debating and arguing about whether there is going to be a recession, anticipating what the Federal Reserve might do, and all of this is in relation to inflation rates that are high and have been surprising throughout much of the year. And so the market is trying to anticipate the next move in inflation and what the Fed might do about it. Well, in the beginning part of this, the third quarter, the market was rallying on kind of a hopeful sentiment that things would be less bad in terms of inflation and that the Fed would be able to lift their foot off the brake sooner rather than later. That sentiment turned during the quarter and the market sold off again, basically ending the quarter at the lows for the year, a little bit lower than the end of June. So it was quite a volatile ride throughout. But the things that are driving the sentiment, like I mentioned, are current inflation rates, the Federal Reserve and other central bank actions and what they might do to address inflation rates, and also pretty significantly what bond yields are doing in relation to that, and kind of looking out farther on the horizon and pricing in bond yields based on what the Fed might do. On page 6, just a simple slide that illustrates the time difference, the amount of time in between market corrections. I have had a lot of clients ask me about market corrections and what we're doing about it. And to be honest, we aren't really able to anticipate market corrections. If we could, we certainly would, and we would probably be able to charge higher fees as a result. But one thing that we do note is that when we create your strategic allocation in the portfolio, it's with an eye toward long-term average returns or the capital market assumptions that we make in-house. And in order to achieve those long-run average returns, one must remain invested throughout the cycle. And that includes both the ups and the downs. So 2022 has clearly been a good example of one of the below average return periods. But those corrections, not only are they a fairly regular part of the markets, as you can see on this page, but the corrections are often followed by above average periods. So remaining invested and remaining kind of sticking to the plan is the thing that we advise. Taking a look at page 7, this page illustrates some of the views of Northern Trust about the main our base case on the global economy and global markets, as well as the main risk cases. One of those centers around what the Federal Reserve might do, whether they will overdo it with putting the brakes on the economy and raising rates too high, keeping them there too long. The other one is Eastern threats, namely the war in Ukraine and the many implications that stem from that. And then the other one being China's GDP growth, which is slowing and underperforming expectations, basically both within China and outside of China. Page 8 illustrates some of the overweight and underweight positioning guidance that I received from our investment policy committee. And it centers around that base case as well as the risks. For instance, we are more favorable toward US equity investments because of the greater risks to Europe and emerging markets. In your portfolio, it's pretty difficult the way the portfolio is structured and those targets are structured to really apply the best practices that I want to. So we're kind of, I'm doing that as well as I can, but I think the things that we'll talk about later will give us a better opportunity to kind of approach managing the portfolio according to our best practices. But in any case, we do wish to be underweight investment grade fixed income. I know you've heard me talk about this a little bit, and overweight high yield bonds. That has been a bit of a struggle this year, but high yield is now outperforming high quality or investment grade fixed income. And we still feel pretty comfortable with that positioning. And unless there are questions from that high level, I kind of went through that pretty quickly, so happy to answer questions. But otherwise, we can move on to a follow-up item that we had from the last meeting.
I don't see any questions.
Okay. Thank you, Chair Tam. And then starting on page 9, I had a section that I included here that went into some of the details of one of the funds that we have in the fixed income portfolio. The ticker symbol is LQD. And that fund if you think about the broad investment grade fixed income market in the United States, that market is represented by the Barclays Aggregate Index, which is sort of like the S&P 500 for high quality bonds. Well, LQD is an ETF that essentially tracks the corporate bond component of that Barclays Aggregate Index. So on this page, you can see an illustration. I was asked at the last meeting to talk about the yield differential between LQD and the index. And what I did was charted the yield over the last few years of two different exchange traded funds, one being the LQD fund that we're talking about, the other one being AGG, passive ETF that mimics that performance and characteristics of the Barclays Aggregate Index. And what you can see on this page is that the yield differential is kind of long-standing. I wouldn't not necessarily say it's permanent, but more or less we've had quite a spread between the corporate component of that investment grade universe and the rest, or the whole universe, as this page illustrates. Any questions on this page right now?
No, it doesn't look like it. We're good.
I'm sorry, I didn't hear that.
We are good. Thank you.
Okay. And then I don't think we need to read through all the details, but I thought it might be helpful for the commission to have the opportunity to look at the different fund profiles. So in this case, we have the iShares iBoxx Investment Grade Corporate Index ETF, that's the LQD. And then if you page forward 3 pages, on page 14, you have AGG, which is that other iShares index fund matching the Barclays US Aggregate Index. And I have other slides that kind of go into more detail about either the economic backdrop or into your performance, and I'd be happy to take questions or wait until we talk later about the action item.
We're okay to continue.
Okay. So I think that's all I had then, but we'll pass the torch on to the next agenda item.
Okay, thank you for this update, Mr. Sutton. I believe that was item number 2, right? The discussion of LQD versus the broader investment grade market.
Yeah.
Okay,
right.
perfect.
Yeah, I didn't articulate as second agenda item, but covered both of those in the last few minutes.
Okay, thank you for covering informational items 1 and 2.
Right.
And are there any questions or comments from the commissioners, city attorney, treasurer, staff? No, doesn't look like it. Mr. Sutton, thank you again for providing the commission with this report. Note for the record that this is an informational item. There will be no commission action. We will now take up items 3 and 4 together. Item number 3, report from Siegel Marco Advisors regarding business and economic outlook. And item 4, report from Siegel Marco regarding the performance of the funds. I'd like to welcome Mr. Nitt from Siegel Marco Advisors, who is here to present these items.
Okay, thank you.
Thanks, Jeff.
I am going to share my screen. So here is our quarterly report. I'll go through the first few pages fairly quickly. Frank's already given you a pretty good idea of what happened during the quarter. But a couple things I wanted to point out. So first on equity markets, bad across the board, as it has been pretty much all year, at least through September. You can see the US was down roughly 5%, international stocks down roughly 10% or even more in emerging markets. And year to date, for the first 9 months of the year, mid 20% negative returns across the board in equities. So it's really been a tough go in the equity markets, at least through September. A little more detail on the US market. Interestingly, during the quarter, we've been seeing value outperforming growth, and a lot of that was driven by energy stocks, which I'll talk about in a minute. But the third quarter is actually more of a growth quarter. And if you look down in this column, the small cap growth actually had a positive return during the quarter, which is pretty hard to believe, but it did. Whereas large cap value, you see, was down over 5.5%. But year to date, again, everything's down. Large cap value not down as much as everything else, and a lot of that's due to the energy stocks. Down in the bottom right, you can see the quarterly and 1 year returns. You can see energy over the last year through September up almost 46%. And that's obviously due to rising oil prices. Everything else negative except for utilities, which are traditionally a defensive sector, that had a positive return over the last year. But even they during the quarter were down another 6%. On the international side, again, bad. A lot of this is due to, and the difference between U.S. and non-U.S. returns has been due to the strength of the dollar. The dollar has been quite strong, so that hurts the returns from foreign markets. But even in local currency terms, still down. You can see here, EFA local currency down 3.5 for the quarter and down 14.5 for the year. So a consistent message there. And emerging markets, again, pretty ugly. A lot of that driven by China. You can see minus 14% for the quarter, 28% for the year. China, as you know, has been locked down. There's protests going on now. A lot of volatility in the Chinese market. That's really a big component of the emerging markets index. Switching over to fixed income, on the upper right here are the yield curves at the beginning of the year. That's this brown one at the bottom. And then the yellow one is end of June. The green one is end of September. You can see really sharp rises. And we know the Fed has been raising rates. The Fed did 2 75 basis point moves upward in the third quarter. They did another one in early November that's not reflected here. But when they did that latest one, that got yields across the board up over 4%. They've come back down since then in the 3 weeks or so, since then, come back down a little bit. But really remarkable shift upwards, especially at the shorter end of the curve. And that's why you've got really an inverted yield curve now, because the short-term rates have gone up so much. And that's really what the Fed controls. And that feeds through into returns. So another ugly quarter in the bond market. The aggregate index down almost 5% and down almost 15% for the year. Investment grade corporates down even more, down almost 19% for the year. High yield actually held up pretty well during the quarter, but still down almost 15%. Again, it's been ugly in the treasury market and even uglier in the other markets. And we've talked about this before, and we're going to see the same picture in terms of your bond portfolios, where active managers have more exposure to the higher yielding segments of the market. And those have been hit especially hard through the first 9 months. But I do have some little bit of good news to share with you in a minute. And international fixed income, again, the strength of the dollar is weighing on some of this, but bad returns across the board, even worse in most cases than the US market. And then Frank alluded to this too, but I put this one chart in just to show, this is not the first time stocks and bonds have been down together in the same year. It's by far the worst. You can see other periods here. But note what has happened following those periods. There's usually a pretty good bounce back in one or both of those asset classes. Now, who knows what's going to happen here? We've got a little bit of good news so far this quarter, but the degree to which stocks and bonds are down is unprecedented. But to Frank's point, you can sort of stay the course And these are long-term returns. So, there should be some light at the end of the tunnel. And the bond math works in your favor. I mean, bond yields, again, treasuries up somewhere in the neighborhood of 4, depending on what the duration is. Corporate bond yields, investment grade, 5-6%, high yield 9 or 10%. So that, if you own that and nothing happens with interest rates, that's the return you make. And that's very different than where we started the year, where yields were very, very low. And that's why the upward moves in interest rates have had such a negative price impact, because there's just been no cushion from yield in the portfolio. Well, now there is. So the picture is brighter going forward for bonds. So with that, as usual, I'll use this fund as an example. All of them are pretty close. On the allocations, I'll remind everybody that at the last meeting, we agreed to do some rebalancing of the 3 funds that don't have quarterly distributions. The ones that do quarterly distributions, we're able to keep pretty close to their target weights just through sourcing those distributions. But the other funds, sometimes we need to take some action. So that's what we did after the last meeting. We took some money out of domestic equities. This is the Benjamin and Cameron and Green funds. And we put some into international equity and some into fixed income. So all of the funds now are pretty similar in their allocations. Everything, just like you see here, is within about 1 to 1.5% of its target weights. And generally the underweight is in international equity, again, just due to relative performance. But we're very close to the target. So no additional rebalancing that we need to do right now. Skipping ahead, here's the performance. As you can see, pretty ugly. Down about 6.5%. Again, each fund's going to vary a little bit just based on its allocations, but all of them are very similar. About 6.5% down, about 0.5% behind the benchmark. Your domestic equity index fund tracked the index as it should. The small cap fund with Boston Trust, which had been holding up very well, underperformed a little bit. And this is really that growth versus value that I was talking about, especially in small cap. This tends to be a little more value oriented, a little more quality oriented. That hurt them a little bit. So they were 1% or so behind for the quarter, but still well ahead for the year and since inception. On the international equity side, down here at the bottom, you see again the growth and value reflected. So Dodge and Cox, more of a value manager. The Euro Pacific Growth Fund, more of a growth orientation. Up until last quarter, Dodge and Cox had been dominating, in part because of that value tilt. This quarter, they underperformed by a little bit, less than 1%, and the Euro Pacific Growth Fund outperformed again by less than 1%. So again, just a reflection of kind of what's going on in the markets there. But we get out to some longer term periods out here, and both are well ahead of the benchmark. So those are just fine. And then finally, our friends in the fixed income camp. So I talked about the difficulty that active bond managers have been facing, and this is across the board. The tendency to own fewer treasuries than the benchmark, more corporates, more mortgages, more other higher yielding things. That's really been weighing on these portfolios, especially Western. We've talked about Western before. This is a pretty aggressive strategy. This is probably not one you'd want to have if this was the only one you had. They produce some very good long-term returns, but you get a lot of volatility in the short term, especially in periods like this. And that's what we're seeing. The MetWest Fund is more conservatively managed, but still is faced the same headwinds that we've seen with the higher yielding instruments underperforming in this market. Now, I told you I had some good news. Through Friday, so far this quarter, Western is outperforming the benchmark by 2%. And MetWest is also outperforming by a smaller amount. So you're starting to see some of that yield buffer coming through. And David, I think you had asked me about the yield in the portfolios after the last meeting, which I reported on after that meeting. And I took a look just so I've got it. The aggregate index is yielding somewhere 4.6 or so. MetWest is about 1% more than that, about 5.6 yield. Western is about a 7% yield, roughly. So just give you an idea of the extent to which Western especially holds some of these higher yielding instruments. But again, rates have backed off a little bit this quarter. Those higher yields are paying off, and that's resulted in some outperformance so far this quarter. So, I think it's probably still going to be volatile for a while, but there is again light at the end of the tunnel, and we've seen this movie before with these bond managers, and they're doing what we expect them to do. We're fine with that, and I hopefully will continue to see positive returns. So the broad bond market is up about 2% this quarter. Western's up about 4%, just to give an idea of numbers. And otherwise, and Frank alluded to this too. I think the U.S. market is up over 10, close to 11%. International stocks are up even more this quarter, somewhere 13% or something like that. So it really has been a pretty good quarter. Still volatile, but pretty good quarter so far this quarter. And we'll see where we end up. So that was really all I had, unless there's any questions.
I don't see any questions.
Okay.
So I think we're good.
All right. I will stop sharing.
Okay.
Back over to you.
So that concludes the informational items on our agenda today. Note for the record that these are informational items. There will be no commission action. Thank you, Mr. Knipp. We have 2 action items before the commission today. The first action item under consideration is item number 1, Mount Hope Cemetery Fund Rebalance Asset Allocation Recommendation. And I will now pass it over to Mr. Sutton to present this item to the commission. All yours.
Thank you, and I will share my screen once again. And I will just concur with Jeff about the current markets. It's been quite a wild ride throughout the year, but this quarter, equity markets are just extremely volatile, and we've seen massive differential between US and non-US markets in both October and November, but in opposite directions. It's quite fascinating to watch. Today, on the action item, though, I did want to present a little bit of information about the strategic targets that are contained and embedded in your investment policy statement. And I think on the agenda, it's referred to as a rebalance. But here, what I'm talking about are the long-term targets that would go into that policy. And to just back up a little bit, in August, we did have in the presentation some slides that covered the capital market assumptions process at Northern Trust, the themes that result from that process this past summer. It completed in August. And then on the right-hand side here, you can see that the 5-year forward-looking expected returns that came out of the capital market assumptions discussion. So these are the assumptions if you were to take a 5-year forward-looking horizon. And the reason why I'm carefully differentiating that from the analysis that we performed is that for institutional clients, I'll use a set of targets or a set of these assumptions that has a longer term horizon. So think of it as a 15 or 20 year set of targets, or 15 or 20 year forward looking. On page 40 of the materials that I sent are the specific assumptions that were use to generate the recommendations that I'm going to make. And so that it will differ from these on page 32. But if you think about it as taking the 5-year forward-looking numbers and blending them with a heavier dose of the historical numbers for each of the different asset classes in question, that's effectively a good description of how we get to those longer term numbers. It keeps us, a little bit more anchored toward the longest time horizon, which is appropriate for perpetual funds such as this Mount Hope Cemetery Fund. And for the analysis that I performed, what I did was I took your current long-term targets from the investment policy statement as it stands right now and ran through the analysis to see what would be the expected return over that long horizon if we just invested exactly according to those benchmarks in the policy. And that generated this 4.9% return. Now, we don't have a specific return target in the investment policy statement. So essentially the thing that I would do, unless I'm given other guidance, is use the same risk return profile to make new recommendations. Then running through the mean variance optimization analysis that we use, and it's guided by those assumptions that I referred to. If we wanted to target a portfolio or create a long-term portfolio with the same target of 4.9% on an annual basis, return target, then on page 33, you can see what the recommended allocations would be per that process and per those capital market assumptions. The optimization effort really seeks to generate a portfolio that if you needed to just set it and not deviate from it using tactical rebalancing and things like that. And if you could invest exactly in the benchmarks at no cost, it's more or less a hypothetical, you can get close, but not quite, then this is what the recommended allocation would be on that proposed column. So the result, though, is it's really a kind of an advance in terms of, this is an older policy. It's a very old fund, and I know it was established many years ago. But in order to step up to kind of the best practices at Northern Trust, best kind of thinking under the modern portfolio theory types of processes, this is what I would recommend. And in order to accomplish that, I've created a set of targets, and we'll talk about that in a minute, but I wanted to pause in case we had questions here. And then it would also require some language change in the policy. So I kind of went through high level how we do the analysis, but do you guys have any questions from the committee about what we're seeing here, what we're looking at? And Chair Tam, you're on mute if you're speaking. I can't tell for sure.
No, I'm just trying to look at the numbers overall, but I think pretty clear. The one question I would have is just, your firm expectations for inflation over the next few years. Do you see inflation rising?
We expect inflation to come back down toward the normal range.
So why would we want 8% in inflation like bonds?
Well, they offer a real yield, just in terms of the distributions. So whatever inflation is, they step up for inflation quarter by quarter. And it's also, it provides a little bit of a hedge against the risk that inflation is higher than we would expect, or more precisely, higher than the market would expect. So it's a hedge against unanticipated inflation. And
but with inflation at 7.7 currently, and then anticipation of it dropping below 5%, I would assume next year, end of next year, would we not be buying high?
Well, what we're buying now is a fairly high real yield, and sort of locking that in with the inflation protected bonds. And we're using, in this case, we're talking about, you see the benchmark that I'm proposing for the high yield area. It's a 3-year target duration of those treasury inflation protected securities. means they're less exposed to the wide swings caused by long-term interest rate changes. And that over the next few years, if you bought TIPS today, the price of those TIPS would incorporate what the market is expecting in terms of inflation. In other words, high now and then declining over the next few years. So you wouldn't be overpaying per se, but you would be sort of capturing that market expectation. And then if inflation were to rise, ahead of what that expectation is, you would benefit from those greater increases in the par value that come every quarter after the CPI is reduced. And the amount, the 8%, is really linked toward that optimization. So the percentage of the portfolio that it would require in order to provide the diversification that TIPS are capable of, it's recommending that 8% out of the 63%. Let's see, there's a question.
And the Russell 3000 index, as far as the risk-adjusted return versus just the S&P 500 index, why go with Russell 3000 after we account for the risk, the added standard deviation?
From a long-term perspective, we would advocate being invested across the market capitalization range of US equities. And the S&P 500 is a great benchmark. It's certainly a well-known benchmark, but it really does only cover the largest components of the US equity market. And in this case, by having the full exposure toward small and mid-cap equities, the better benchmark would be that Russell 3000. I agree, some investors would not want to invest in small cap, but we believe that small cap and mid cap stocks, to a similar degree, offer additional diversification. If you think about the difference between the S&P 500 and the Russell 3000, those are 2,500 additional enterprises to which you're gaining some exposure. Small cap has, over long periods especially, demonstrated the ability to have higher returns, albeit with a little bit higher standard deviation. So blending it in at the right levels, 2% out of that 27% for US equity, 2% out of the 16% for US equities is kind of an appropriate level. It's modest, but meaningful exposure.
It does reduce our potential dividend yield when we're heading into those sectors. So being that we do want current income, do we feel maybe more dividend paying stocks would be appropriate than
Actually,
a small
yeah,
cap
I agree.
portfolio?
I agree with that. And if you think about just the index level, the new proposed lineup gives us a higher yield overall.
Mm-hmm.
And then beyond that, in terms of implementing the portfolio, I'm mindful of that language in the policy, and I'm not suggesting we change it. And so the implementation, the tools, the funds that we're using to actually get this exposure in the portfolio, I'm gravitating toward higher income oriented funds, but I'm doing so in a way that I'm hoping not to take undue tracking error risk and undue risk generally by seeking just high yield.
Okay.
And the overall, expected return doesn't change much, and these numbers are small enough, the differentials are small enough that they really amount to almost a rounding error. But with a similar standard deviation and a little bit of an additional efficiency, you get a better compounded return. And the compounded return is simply a different math. The 4.9% is what you might expect on a single 12-month period basis. The compounded return is taking a number of these iterations of the modeling the probabilities of return in a given year. Think about this table here, where you think in a year a wide range of things are possible, but over a multi-year period that range narrows down. So in a single year, you can have volatility from year to year. And when you link the above average years and the below average years together in what's called a geometric average, or that's the compounding by which we calculate your returns, greater volatility knocks down that compounded average return. So the higher compounded return is really what you end up keeping. So I'd say that's important, albeit not terribly significant, because we're not changing the total risk profile.
I see your expected yield is 3%.
Yeah.
Anything we can do to take advantage of the short-term fixed income out there? I know there's Citibank's got a 3 or 4 year paying over 5.5. Goldman's got, a 3 or 4 year paying over 5.5. CDs are paying 4.9. Anything you can do to take advantage of the short end of that yield curve, since we're facing a very rare opportunity?
Yeah, I do. I kind of agree about the opportunity, and maybe what I should do is add, at least for part of, and this, by the way, Chair Tam, pertains to a little bit of a different discussion. If we were to change the policy, we're talking about the long-term targets, but in terms of the implementation of the day-to-day implementation, I could look for a short-term fund. We have a couple of things on the platform that would take advantage of that inversion in the 1 year, 2 year range, higher yields and higher and low duration. So less
Instead of a
interest rate risk.
fund, could you purchase T-bills or CDs or individual corporate bonds on the short side?
You could, but you get a great deal of diversification in a fund, and if you can
We also
find
get
it,
variability of yield, and yields aren't likely to go up on the short side.
right.
So
Well-
why not lock in, 100,000 in a 2 year CD paying 4.9 with zero risk when you're offering me a long-term return of 4.9 with standard deviation of 5.7?
So are you speaking of like maybe looking at a whole different kind of a policy where,
No,
Or-
no,
or
I'm just
talking about
saying
as a
you have the
component-
ability to purchase individual fixed income securities. This portfolio has done it in the past. There's
right?
an opportunity here to take advantage of risk-free assets. Why not purchase some treasuries individually?
Well, I mean, our best thinking at Northern Trust really would guide me toward using a fund, because if you think of a 2 year, say a short to intermediate duration fund, or even a short duration where you have a 1 to 2 year duration, by buying the fund, you get that same impact that you're talking about. The fund itself is purchasing bonds with a 2 year maturity, which it then holds until they mature, and constantly reinvesting. So while it is true, if you
But
own a
you're
single,
adding on a management fee. So why not just buy it from the US Treasury and get that yield while they're this high? It's rare that I would, favor buying an individual treasury or a CD, but
Yeah.
let
me take a look at that.
The yields make sense. At least
David.
in the last 2 months, it made sense.
I certainly can do that. So I'll take a look, and
It's
maybe
within your
absolutely. Yeah, we would,
policy. Yeah.
whether we switch the policy out or leave it the same, I could still do that. So I'm going to make a note to ensure that I take a look at the real possibilities and differences. One thing I can think of is that by buying individual treasuries, you get a specific yield. With the fund, you tend to get a spread. With high quality corporate bonds mixed in there, you get a spread that I want to check to make sure it offsets the differential that would be, the cost that would be applied.
Yeah,
right? Using a fund.
we've had individual bonds in this portfolio before, and it's, not often that individual bonds make more sense
right.
on the short side. But we're in this window of opportunity. Why not take advantage of it?
I didn't want to forget, so sorry for me being distracted with my note. That's a good question and good thing to think about. All right, so here then, regarding the long-term analysis, I've kind of talked about the expectations of the total account. It does improve the yield a little bit, and if you look through here, some of that advantage is in just adding these sectors that we have exposure to currently, but they're not in your policy technically. So versus your current actual profile, it would be a small difference. But I really do like having these individual components in the portfolio with their benchmarks, and it gives me a starting point to apply some of that guidance, which the way the policy is written right now, it's up to a lot of interpretation. And so I'd rather have like a clear starting point, apply the guidance in sort of the nomenclature of the Northern Trust strategists and things. It would probably improve our yield to some degree because we're adding high yield as a specific component. The more important thing would be, like I'm doing now, is I have flexibility within those ranges to increase the exposure, but here it's actually added as a specific target. I'm trying to think what else I would say. We're not so much reinventing with all these different components, but making them more clear and specific in your policy. And in order to do that, if the committee were to agree with what we're talking about, what I'm recommending is that we adopt a table. This table on page 39 is the one that I'm proposing, where it takes from the analysis, it takes those strategic targets, and then we apply ranges around each one of those targets. And it would kind of just neatly be embedded into the policy the way it's written now, with a couple of exceptions that I'll talk about in a minute. But from the targets and ranges perspective, do you or anyone else have questions? And I thought there was a note in the chat where someone wanted to speak.
John.
Commissioner Peel.
Yes, Chair Peel.
Yeah, you know,
Question?
actually, my questions were answered in all the discussion, so I'm good.
Oh, great.
Perfect.
All right. Nobody wants to hear me repeat myself. Okay, well, any questions then about the table from anyone? Then the second of the two action items is that in order to really not tie myself in knots down the road, the language of the policy needs to be adjusted, because the way it's written right now.
Should we take a vote first on item
Oh.
1, or are they going to be?
Actually, I think they're tied together enough
tied
that we might
together?
want to at least talk
Okay.
about it and then decide.
Sure.
The way a couple of things about the policy. One, within the policy, the way it's written, it mentions specific components of the portfolio and specific benchmarks. And so we're negating those references by containing the benchmarks for each one of these asset classes and sub-asset classes right here in the table. And two, in a few areas, there are references that sort of put boundaries within boundaries on various sub-asset classes. And the one that comes to mind, I hate to jump around too much, but it's regarding emerging market equities as a percentage of total international equities. And so by creating a table with very specific targets and ranges, it's something that I can systematize better and make sure that we don't breach any of those boundaries. And it just makes it a little bit more straightforward for me to decide, well, if my investment policy committee wishes to be overweight emerging market equities and underweight high yield bonds, and et cetera, it's a whole lot easier to manage. So part of it is selfish, but I also believe we're kind of moving toward kind of a best practices approach altogether with the individual full diversification, individual sub-asset classes.
Okay.
And I don't know if you all have had a chance to review some of the red line language changes, but they're here and I'd be happy to either talk about it or answer questions.
So this is in regards to the item number 2, Mount Hope Cemetery Fund Investment Policy Recommended Revisions. Does anyone have any questions on the language change? Hearing none. Anything to add, Frank, before we take a vote?
No, the only thing I would say is that what I've been trying to do is manage using this type of thinking, but with the old style of policy. So it would make my job a lot easier because I feel like it's important for me to use as much as I can, the best thinking at Northern Trust, but it really didn't fit perfectly well into the older policy. Some changes were made a couple of years ago, and I'm sort of just, I think we can advance the ball a little bit more right now.
Okay. Mr. Sutton, thanks for bringing these items to the commission. This item does require a vote of the commission to decide on whether to accept these changes. So why don't we start with item number 1? Is there a motion to accept the rebalancing asset allocation recommendation from Northern Trust? All right. I see we have a motion from Mara Elliott. Do we have a second?
I have a question,
Liz?
Chair Tam, I'm sorry.
Go for
So
it.
can we approve this reallocation without having approved the new investment policy, or they are not in conflict? Maybe that's a question for Frank.
Frank?
Or
I
Brett,
think
do you have?
you could, but it would tie me into knots if you approved the table, but then did not approve the linguistic changes. Is that what you're referring to, Liz?
Yeah, I'm wondering if we should be approving item 2 first. I'm going to defer to our attorney here who is about to say something.
That's a fair idea. Yeah.
Yeah, I would advise, I didn't even notice the order of the two and put that together, but I mean, you could make a motion to pass it contingent upon the changes to the investment policy being approved as well, to keep the order the same of the items as they're heard.
Okay. So let's amend that motion to have item 1 pass contingent upon the passage of item 2. So we do have a motion by Mara Elliott, and do we have a second? I think John Peel, second by Commissioner John Peel. Will now take roll call to count the vote. Commissioner John Peel.
Aye.
City Attorney Mara Elliott.
Aye.
City Treasurer Liz Correa.
Aye.
And myself, David Tam, I vote aye. That motion passes unanimously. So let's move on to the second action item, which was the Mount Hope Cemetery Fund investment policy revisions. Are there any more questions on item number 2 before we proceed? No? Okay, is there a motion to accept the investment policy recommended revisions from Northern Trust? John Peel. I see we have a motion from Commissioner Peel. And do we have a second? Mara Elliott seconds the motion. Let's go ahead and take roll call. Commissioner John Peel.
Aye.
City Attorney Mara Elliott.
Aye.
City Treasurer Liz Correa.
Aye.
And myself, David Tam, aye. That motion passes unanimously. Okay, that concludes the action items on our agenda today. Let's move on to the next item on the agenda, comments from commissioner or staff. Do any of the commissioners or city attorney or staff have any comments? I don't see anything. Okay, we'll now move on to the next item on the agenda, non-agenda public comment. At each meeting, we invite public comment for up to 3 minutes about issues within the commission's jurisdiction, but not on the agenda. This afternoon, we have 0 speaker slips turned in for non-agenda public comments. So let's move forward to the next item on the agenda, scheduling of the next meeting. Let's determine the availability for next meeting. It'll be mid to late February. Let's say peak.
Chair Tam,
Yes.
I might have missed my turn during the public comments from commissioners, staff, or public comment. I wasn't sure where, but I just wanted to make one comment, which is that I would like to introduce the committee to another, a colleague who's now going to be located in Southern California. It's a portfolio manager that I've worked with for all of the 11 years or so that I've been in this role.
Oh,
And I would like to just kind of bring that to your attention and introduce her at the next meeting. We will sort of like the way Pat Everett and I did previously, provide backup and overlap with each other. And at some point, it might be convenient and appropriate to switch responsibility to the local portfolio manager. I'd like you to meet her before we get to that point.
Okay, so at the next meeting, Frank, is that
Yeah,
right?
that would be
Okay.
great.
So Jeremy, if you don't mind adding that to the agenda. for
Yeah,
the
that'll be
next
good.
meeting.
And I think Frank is gonna provide a bio of the new person that will be included in the packet as well.
And for the record, her name is Allison Bonney, and I'll certainly send that to you,
Do you
Jeremy.
have the spelling?
Allison, ALISON, BONNEY.
Perfect. That helps for the recorder.
Sure.
Thank you. All right, getting back to the calendar. And today is a Tuesday. Are Tuesdays good for everyone? Tuesday, the 21st? Same time? Is that okay? I see nods.
Is that February?
That would be February 21st, Tuesday at 1:30.
Just noting that city council meets at 2 p.m. generally on Tuesdays, so that may not for the city attorney work or meet. So
Yeah, tough to know what's going to be on the agenda that day. If we start at 1:30, then at least I could join you for 30 minutes if I had to go to council for some reason.
I mean, Wednesday's fine for that week for me, if we want to move it to Wednesday. Same time, 1:30.
Okay.
Yeah.
I'm seeing nods.
what day?
That's Wednesday, February 22nd.
Okay,
Is that okay?
yeah,
Yes.
there, we have a DPWG meeting on the 15th, so we're, yep, we're good.
Nice. I think we found it. So the next meeting will be February 22nd, 2023. That'll be 1:30. And Jeremy, you just let us know if it's Zoom. We love not having to park in that parking lot, or if it's in person, just let us know.
Yeah, and that's actually a good point and something to bring up.
Yeah.
In our Office of Boards and Commissions Liaison meeting, we did get some guidance from the advising attorney to the OBC that us continuing to meet virtually is contingent upon the governor's executive order, which is scheduled to expire, I believe, at the end of February. They're going to be sending out some formal guidance that I will be able to pass along to the commission, but it should go again through the end of February, and that's why in the script I did have the meeting scheduled mid to late February, so we can meet at least one more time
Thank you.
virtually. Yeah.
Much appreciated. So any other questions or comments? Okay, I think we're good. This brings us to the end of our meeting. The next Funds Commission meeting is scheduled for February 22nd at 1:30 p.m. Happy holidays, everyone.
Thank you.
Happy New Year. I'll see you in 2023.
Thank you.
Thank
Bye.
you.
Thank you
Thank you.
all.
Bye now.
Bye.